Welcome to Lender's Digest. I'm Alex. Today we're diving into a critical yet often overlooked aspect of the financial world, lending in rural communities. As urban centers continue to grow, it's easy to forget that vast swathes of our country remain rural, with unique financial needs and challenges. Let's start with some context. According to the USDA, rural areas cover 97% of America's landmass but contain only 19% of the population. This disparity creates a distinct set of circumstances for financial institutions operating in these regions. First, let's address the elephant in the room: the decline of community banks. Over the past 3 decades, we've seen a significant reduction in the number of small, locally owned banks that have traditionally been the backbone of rural finance. This consolidation has left many rural communities with limited access to personalized financial services. But it's not all doom and gloom. This vacuum has created opportunities for innovative lenders willing to adapt to rural needs. Take, for example, the rise of ag-tech lending. As farming becomes increasingly high-tech, there's a growing demand for specialized loans to finance precision agriculture equipment, drone technology, and smart irrigation systems. I spoke with Sarah Johnson, CEO of Heartland Financial, a mid-sized bank focusing on rural markets. She told me, "We've had to reimagine our entire lending approach. It's not just about land value anymore. We're looking at data on crop yields, weather patterns, and even satellite imagery to make lending decisions." This shift towards data-driven lending is a double-edged sword. On one hand, it allows for more accurate risk assessment and potentially better terms for borrowers. On the other, it requires significant investment in technology and expertise, which can be a barrier for smaller institutions. Another key trend is the rise of community development financial institutions, or CDFIs. These mission-driven lenders are filling gaps left by traditional banks, often focusing on underserved rural areas. The Treasury Department's CDFI fund has been a game-changer, providing capital and tax credits to these institutions. But let's not forget the challenges. Rural lenders often face a unique set of risks. Geographic isolation can limit diversification, making portfolios more vulnerable to local economic shocks. Climate change is another looming threat, with extreme weather events potentially devastating rural economies dependent on agriculture or natural resources. Regulatory compliance is another hurdle. While necessary for financial stability, the cost of compliance can be disproportionately high for small rural lenders. The Community Reinvestment Act, while well-intentioned, has been criticized for not adequately addressing the realities of rural banking. So what's the way forward? Innovation seems to be key. We're seeing interesting partnerships between fintech companies and traditional rural lenders. These collaborations bring together local knowledge with cutting-edge technology, potentially offering the best of both worlds. There's also a growing recognition of the need for tailored financial products. Seasonal income streams in farming communities, for instance, require different loan structures than those used in urban areas. Some lenders are experimenting with revenue-based repayment models, aligning repayment schedules with the cyclical nature of rural incomes. Education is another crucial component. Financial literacy programs targeted at rural communities can help create a more informed borrower base, potentially reducing default rates and fostering economic growth. As we wrap up, it's clear that rural lending is at a crossroads. The challenges are significant, but so are the opportunities. For those in the finance industry willing to innovate and adapt, rural America represents a vast, underserved market ripe for growth. This is Alex for Lender's Digest. Until next time, keep your eyes on the horizon and your feet on Main Street.